a lot of write-offs help you pay less in taxes, but they don't help you qualify for a home loan.
Hi, it's Ashley with Keller Williams Real Estate here in Everett, and I am with Catalina Traylor. She's a loan officer, and she's going to be talking to us about something really important, which is if you are self-employed and you want to get a mortgage, how do you do that? Right?
Yep.
So I do want to welcome you, Catalina. Thanks so much for coming.
Yeah,
And
thank you for having me.
yeah, I'm really excited. Maybe you could just tell people a little bit about your background, and then we'll get into the meat and potatoes.
Absolutely. So I kind of taking a big step back. I have a degree in public health, so it's really important for me to be an educator and really give people their options as far as, how to make their best life possible, whether that be in finance or health. For me, I started off as a financial advisor. So I worked with a lot of people on personal financing and educating them on just the basics. And then I moved into mortgages in 2020, where I worked as a processing assistant first and foremost. And then I moved up to a processor, and then I moved up to loan officer assistant and becoming a loan officer myself. So, I've been in a lot of different places already. And so I like to think that it gives me a really great holistic view for mortgages and for helping people understand their home loans.
Yeah, oh, wonderful. Well, that's good. I know. I think having been a processor really like helps you understand deeply like what's needed and how to actually get it done. So that's
Definitely.
fantastic,
Yeah.
fantastic. So I'm really excited about the topic today, which is talking about getting mortgages for people that are self-employed. And maybe we could talk. Maybe you could tell us a little bit about like who would this be for? Like, what is self-employed? How do you know if you are? I mean, obviously some people will know, but like, what would be an example of like, oh yeah, boom, you're self-employed for sure.
Absolutely. So people that work as 1099s have Schedule Cs on their taxes right after their 1040. They would be filling out a Schedule C. Any sort of S corps as well, or LLCs that they would be operating under. Those are all people that would be considered self-employed. And really, like we even asked this question on our loan application, is if you own 25% or more of a business. So even someone who maybe works as W-2 but has a 30% share in some business, you do have to check that box, and we do have to document that income as well. So I'd say any of those forms, if those ring a bell, absolutely. Anyone who owns 25% or more of a business also fits that category.
Yeah, wonderful. Well, I think that's really good. I mean, I know that there's a lot of 1099 people out there. I mean, obviously, like our economy's changed a lot, right? There's a lot of people that are doing contract work.
The
And
gig economy, right?
yes, and
Yeah.
and they would also like to own houses. They don't want to rent forever. So this is the way forward. Okay. So I know we talked about like, there's like maybe two ways to get this documentation, right? There's going to be like a little bit of preparation and things to
Mhm.
know. So maybe we could talk about the two pathways that you see as far as getting the documentation.
Absolutely. So there's the more traditional way, I'd say, just because it's what people have always kind of talked about, or like a very common pathway to go down for self-employed. And that'd be the tax return route.
Yep.
So we'd require 2 years of tax returns. Typically, there are some exceptions in there, but typically we need 2 years of tax returns. Um, and you have to give us all your personal and business taxes. So we need to see kind of everything laid out there. And again, we need 2 years of that. So, like I said, really good for people that have been established for a while. 2 years, not so bad. There are newer businesses that kind of can struggle with that. So, a lot of people, it's really motivating after their second year of business to like get their taxes done ASAP. I have a
Yeah.
few people right now that says, oh man, like 2021 was really tough for me. 2022 was really good, and 2023 is going to be a really good year. So I have a number of people right now that are really working on prepping to buy sort of early next year, given 2 years of tax returns. So that'd be one pathway.
Yep. And so with that pathway, what are some, I don't know, potential pitfalls, right? Like, I mean, obviously you need to make money, right? Like the business needs to show that it generates income, but maybe we
Mhm.
could talk a little bit more in detail about that. Like, I mean, you're probably not going to get a mortgage if your business made like $5,000 or something.
Right, right. So, it's difficult because in the beginning, in a startup of a business, I get it, right? Like you have a lot of expenses. You're investing in your business. You aren't paying yourself much at all, if any. And that's a really common struggle for a lot of new businesses. So, that's kind of a difficult path to go for, again, newer businesses, just because they're not making a lot of money right now. Or if they are, they're like having a lot of write-offs. So that way, and so that kind of goes in more established businesses, right? It's maybe you have been established for a while and you're really kind of in some of your more income earning years, but you're writing off a lot for your business because that helps when it comes to tax time. A lot of write-offs help you pay less in taxes, but they don't help you qualify for a home loan.
Love that. You said it
Yeah,
perfectly. Yes, doing a lot of write-offs help you not pay taxes, but it doesn't help you qualify for a loan.
exactly. And it's something that people don't really think about. So, something that we can look at is if people come to me sort of in the fall looking to buy in the year, or even, the beginning of the following year, they're oftentimes talking with their CPAs about, okay, how should I be filing? What are our numbers looking like? And the great thing about like an S Corp, for example, structure is that, you can talk with your CPA on saying, hey, this is what I'm looking to qualify for. And your mortgage lender can partner with you on saying, okay, this is what we need to show in income. And, you can take an extra bonus or like increase your payment for the year as well. So that's kind of a way around that if you are looking to shop in the right time of the year.
Well, I think that's fantastic, especially the collaboration with the CPA. That hadn't really occurred to me, but I think having that conversation in advance, like, okay, I need my tax return to look this certain way so that I'm showing income, I'm paying taxes, and it will then allow me to qualify for a mortgage. I think that's
Right.
good to have up front.
Yeah.
Wonderful. Okay. Any other pitfalls that might, I don't know, come up when you're trying to go that route, the tax return route?
So something else to consider is if your business is 5 years, or if your business has been established for 5 years or less, we have to use an average of 2 years of income. If your business has been established for longer than 5 years, we can have the option just to use the most recent year of income. Now, we still have to document both, but we can choose to only look at the most recent years. So, for example, right, 2021, really hard year for a lot of small businesses. 2022, a lot of boom. So, depending on sort of when their business was established, we could just say, hey, we're just going to use 2021. And sometimes that gives people an extra $2,000 to $5,000, depending on the scale of their business, by
Oh,
just looking at 1 year's returns versus averaging out over two, just because of the economy and the volatility that we've had
sure.
over the last few years. So
Yeah.
that's also something to keep in mind, that we have to use 2 years of average if your business is within its 5 year period.
And is it the past 2 years? So like it's just
Yes,
boom, boom, boom. Okay.
correct.
And then if it's longer than 5 years, then you can just use the current year.
Yeah, the most
The
recent,
most
the
recent
most
tax return.
recent filed. Yes.
That makes a difference. So does that requirement ever change, like with what the economy is? I don't know. Like I'm just sort of like throwing it out there. It might. Do you have
Yeah,
any?
so there's certain things like during COVID, right? There was a lot of small businesses that were going under, or were established really well and like paid a lot the year prior, but they like hadn't had many clients that year. So we were requiring, and all the lenders were, a P&L, and also within closing, it was like within the last month, you had to show a paid invoice from a client to show that you had been receiving pay and documenting income within 30 days of closing. So, there's definitely like some we call them overlays. It's kind of like, okay, here's a normal requirement, and now we're going to add this overlay for the extra benefit or that extra security from the lending side to make sure that even though you made $100,000 last year and you're still operating and you're still functioning as a business today. So those overlays have gone away because of after COVID, but it's not to say that they can't come back if something were to happen like that again.
Yeah, and this is the part that's really interesting to me because, the overlays are so crazy. Like, I remember that, like, they would be like, oh, well, if you're self-employed, we're only going to count half of your income. It doesn't matter, like they just come up with some like, seemingly arbitrary number. They're just kind of like, oh, the economy is going to lose 40%. So are you. So
yeah,
you said you made that last year. Well, we're just going to cut that right in half. Thank you.
right. Yeah.
All right. Well, that's awesome. Okay, so you mentioned tax returns is one avenue, and then the other avenue is bank statements.
Bank statements. Yep.
So, before we go, hold on.
Uh-huh.
We haven't talked about the benefit. So the benefit of using the tax return is that it's a qualified mortgage product.
Correct. Right? Yes. So that's why I say more traditional avenue, yes. Because it's a qualified mortgage, and so there's essentially just more regulation around qualified mortgages, which means that your rate overall is going to be lower compared to a non-qualified mortgage. Yeah. Qualified mortgages, in the eyes of lenders and banks and people that are lending the money, they are safer compared to non-qualified mortgages. So that's why I say the traditional way, if you go the tax return route, your rate is going to be lower in comparison to the other product that we're going to talk about, or the other program, which would be bank statements.
Okay. Yeah. So that's good to know. Like, if you're out there and you're planning, it might be good to try to go this route, get the tax return going.
Yeah, absolutely. And, if you have a long enough runway, I just met with somebody this week who, she's newer in her business, and, she's like, okay, I know I want to buy sometime next year. And so it was perfect because I could sit down with her, we can go over the numbers, and we can really get a plan in place. And she goes, I'm so excited to do my taxes at the beginning of 2024. Like, she's super motivated to do it. So yeah, it's depending on your runway. I mean, it can be a really good option.
Yeah, wonderful. Okay, now we can go bank statement.
Bank statement.
Right, let's talk about this bank statement route.
Yeah, so you can do 12 or 24 months of bank statements. And the caveat basically is that it has to be personal bank statements or business bank statements. So this is also talking about, runway, preparing for applying for a mortgage. I don't know where that like stipulation comes from, but it just is how it works. You have to either have, again, bank statements like deposits or invoices through your bank statements that you would provide, or just through personal. So again, 12 or 24 months, either one. And we will take a look at all your qualifying income deposits on your bank statements. And so we'll add all of those up. Say there's a valid deposits of $350,000 over the last 12 months. Right. We will take a look at your ownership, and we will assume a 50% expense ratio. Now, you can change that, or we can use a different number if you think your business does better than 50%. We would just require a year-to-date P&L or a P&L for that 12-month period of time that you'd be submitting bank statements for.
I see. Okay, so it's possible to use actuals.
Absolutely.
Okay.
Yep.
So, I mean, like, if someone can provide the P&L, like an up-to-date P&L with the actual numbers, I mean, is there a reason why maybe the underwriter might say, no, we can't use these actuals,
No.
we're gonna have to do, okay, so they'll just use it no matter what.
Yeah, oftentimes, I mean, most of the business owners that I have worked with, I mean, they just don't keep up their P&L like every month.
Right.
So like a lot of people do it at the end of the year, right? Like they have all of their stuff, they use QuickBooks, their CPA puts it together, everything like that. So, a lot of people will just default to the expense ratio because they don't want to basically do the work to like be like, oh yeah, that's about right. Like that's good enough type of thing. So you can absolutely use your own P&L and we can look through that.
Okay. And just to be clear, what you're saying is if someone does not have an up-to-date P&L, you guys assume that 50% of the income goes to expenses.
Correct.
Okay, so you would only use half of whatever the deposits are.
Yes.
Okay. Okay.
And then also take into account whatever your ownership percentage is too.
Oh
So
yeah.
like let's say you have a business partner, right? So
Yeah,
we're
you
going to take
own
half.
50%.
Yep.
Oh,
So
wow.
it can get whittled down
Quite a bit.
very easily. Yeah.
Sure. Sure. Yeah, I could see that. Definitely.
Yep. But on the other side of things, right? If your, income, right, you have the majority of your write-offs, right? Well, what we're looking at on bank statements, we're not necessarily assuming, that we're not seeing all your write-offs for your business, right? We're just seeing your gross income into your bank statements, which can be significantly more for a lot of people when it comes to their income.
Yeah. So are you saying that when you look at the bank statement, I mean, obviously, like if someone has a bank account, like they might have whatever deductions for expenses, right? Like whatever it is,
Yeah,
it tracks out. So
we don't know.
yeah, you wouldn't have all of them, but like I don't know, this is kind of be like a weird scenario specific question. But if at the end when you calculate the deposits and the things that come out, like what if it's like I don't know, less than 50%? What if it's like all that's left is 40% or something? I don't know. Like obviously
Yeah,
you
I
guys
mean,
know math, you're not like idiots, right? Like is that weird?
right. Yeah. I mean, with the P&L, if the P&L shows, it's like, hey, you're keeping 70% of what you're making. I mean, great, and we'll use those numbers, no problem. So we have no issues using the actual numbers with what you're submitting.
Okay.
Yeah.
All right. And so what else would someone need in order to do that type of loan? The bank statement version. That's it.
Yeah, that's it. It's just 12 or 24 months personal or business bank statements.
Okay. Do they have to provide you with this is like kind of a bit of a word question, but do they have to provide you with like incorporation or like business licenses?
Yeah, so that goes
Okay.
into just like self-employed in general. So we'll want things like business licenses, um, any sort of K1s, like, and that just kind of goes into the tax documentations, things like that.
Okay.
Um, yeah, but for the most part, I mean, it's just part of the income stuff. And it's not too big of a deal, not too nothing out of the ordinary, nothing crazy to document.
Sure. Okay. And then what are like are there any pitfalls here to avoid with this type of documentation?
So the idea behind bank statements, right, they are non-qualified mortgages. So what that means is that there's qualified mortgages that again kind of check all these boxes that we want, and it's relatively easy to lend these people money in this box. When it comes to non-qualified mortgages, it's kind of for out of the box solutions, right? So we kind of think of qualified mortgages as this box. It's nice and tidy, wrap it up in a little bow. The non-qualified mortgages, everything around the box in a little pretty bow.
Sure.
So with bank statement loans being non-qualified mortgages, there's more risk that the lender takes to lend that money to someone because we're not requiring you to provide your tax returns and what you reported to the IRS. We are going off of straight bank statements that you are providing us.
Right.
So if you can, kind of understand the difference between those two types of documentation, we also just a side note as well, whatever income documentation you send us for tax returns, we also have you sign a form so where we can pull the transcripts from the IRS to
Mm,
confirm that what you have sent us is what you filed with the United States government as well.
mm,
So, there's an extra layer of security there because we can double check that. With bank statements, like I said, we're using raw numbers, we're going off of what you're giving us. So, because of that extra layer of risk, your rate is going to be slightly higher compared to qualified mortgages. So, that's why there's like so many facets between these two. And it's my job to really help you determine which one's going to be the best bang for your buck, which one is going to give you more income, which one's going to give you a lower rate, and kind of see, okay, at the end of the day, which one's going to be better for your income situation.
right. Yeah, because I could see the higher rate could be like a bit of a, at least from the borrower's perspective, kind of like a double-edged sword, right? Because it's like, yeah, you have the flexibility of providing bank statements, but the higher rate means that your DTI is going to be different, right? Like you might not be able
Yeah.
to qualify for as much for a lot
Yeah.
of reasons, right? Like if you use the
Mm-hmm.
assumed expense ratio, that's
Mm-hmm.
possible, right?
Yeah.
So,
I mean, it also limits, if you're a first time home buyer, there's no like FHA, for example, won't do bank statement loans.
mm,
So for FHA, which a lot of people go FHA because of the minimum down payment for first time home buyers, 3.5%, you have to provide tax returns for that. So there's a lot of like first time home buyer programs that you're not going to qualify for
mm,
because all of those are qualified programs. Again, it's
mm,
they want to lend money to these people that are going to be a sure thing and fit into this box, nice and pretty.
yeah,
Again, bank statement loans a little bit messier, and they want to give the money to the less risky group of people, which would be in the qualified mortgage box.
yeah. And since you talked about down payment, I mean, can you do just standard down payments on these? Does the underwriter kind of like go back and like look at the income and say, we have to do 30% on this one, or could you just do like a 5% down? I don't know.
Yeah, with conventional, the any and all like all the rules, the same rules apply to salary employees versus self-employed people.
Okay.
So in qualified mortgages, conventional mortgages, that all means the same thing. So people can put 3 to 5% down as
Okay.
their minimum for conventional, and 3.5% down for qualified mortgages for the FHA.
Okay.
For the bank statement loans, it depends on the lender. So you can shop certain lenders. And by lenders, I don't mean like loan officers. Like one loan officer can have access to multiple different lenders. So
Right.
that's like part of their job, right? Is to shop around for you for like to find your best deal. And to see what program works best for your situation. So if you are someone who's looking to put 5% down with a bank statement loan, maybe some low, because again, that's even higher risk, right? When we look at down payment from a lending perspective, the more somebody is putting down, the more skin they have in the game. So the less risky that they are seen as a borrower.
Yeah.
So with a low down payment and a bank statement loan, you're going to be looking at probably a much higher rate. Now, not to say it's impossible to do 5% down on a bank statement loan, but it's probably just going to be, like I said, a pretty expensive on a monthly basis for that.
Sure. Is there like a sweet spot on those bank statement loans for down payment?
I think it would just be depending on the lender.
Oh, it
Yeah.
just as a lender. So there's not like it would be better to be at 20% or it doesn't really matter.
I mean, 20% is always good.
I don't know.
20% or
Like I'm just sort of asking,
25%.
if you're
Yeah.
planning and you could have like the ideal situation, like for you, someone's doing a bank statement loan, they have to do it that way. If they had 20% down, it's kind of like woohoo. If it's 5% down, you're like, this is gonna be rough or what? I don't know.
Yeah, I mean, it really doesn't make a difference on my end. It's just I think about the affordability for the client. It's okay, what do we need to sort of make happen here and what can they afford? So yeah, I mean, more down is always going to yield a lower interest rate, but it's also looking into like where the market's at too, because like non-qualified rates can fluctuate just as much as qualified mortgage rates. So sometimes it's going to be insanely higher, or sometimes it's going to be more affordable. And so it's just really kind of on a case by case basis.
Okay. Okay. And then what about like credit score? Is it kind of treated the same? for both?
Yeah, it's pretty much the same across the board. Like just like, down payment goes, for conventional or qualified mortgages, anywhere from 740 up is considered an excellent score. Um, FHA, we get into, you know, it's more favorable towards lower credit score people. So like sub 700, FHA is a really good option because they like have less of a rate increase for lower scored people.
Mm-hmm.
And because that's how rate works. Like there's all these factors that affect what like there's like always a minimum or like a standard rate that the market is trading at. And then
Right.
let's say you have a score that's sub 700. Well, now your rate's going to be up here. And then let's say you have a 5% down rate or 5% down payment. Well, your score is going to be up here. On the
Yeah.
opposite side, that's also true, right? So if you have an 800 credit score, your rate's going to be a little bit lower. If you have 25% down, your rate's going to be a little bit lower. So there's all these factors that kind of go into, is your rate going to go up or down from what we can offer you? So the strongest buyers have high credit scores, high down payments, and do conventional loans. But again, not to say that there isn't a way to get into homes for people that don't fit into those boxes. And that's really the fun part about my job. Like, bring me those cases that you have. It's like, I want to buy a home and this is what I have to work with, right? And so we can find a solution for you.
Yeah, I mean, I think that's great. I think finding the solution. I think many people don't realize like how many different like loan products there are, like how
Mm-hmm.
many different solutions are possible in order to get people into homes. And yeah, I think it's fantastic. I think that the work you do is great. I mean,
Yeah.
yeah,
Thank you.
I think it's wonderful. It's really good work because I don't know, a lot of people, they want to own houses and they want their own. I don't know, like there's a lot of reasons, right? No sense
Yeah.
of pride. There's a lot that goes into to owning a home. So I think it's fantastic. Is there anything else that we maybe missed on the self-employed borrowers?
Um, I don't think so. Those are really the two main sort of avenues that people go. With the COVID overlays being gone now, it's even more achievable, I'd say, for self-employed people. But, you're never going to get dinged. And by dinged, like penalized for being self-employed. That's something that I've had a lot of people say, like during my workshops and things like that. And it's like, oh, I thought that, I'd be seen as higher risk. And it's like, absolutely not. You aren't seen as higher risk as self-employed compared to a W-2 person. It's just different documentation that you submit, on the qualified mortgage side. So yeah, there's like nothing.
They must mean the overlays. They must mean the overlays
Maybe
because
that's it. Yeah, it was just
it's like,
harder to.
like I would feel penalized if someone said to me, "Oh, well, your business is doing great, but because you're self-employed, we have to take half your income off."
Yeah, like
That would
that.
feel like a penalty
That's
to me.
yeah, absolutely.
Yeah.
Yeah.
So maybe
So
that's what
yeah,
it. Yeah.
that's possibly it. But yeah, I mean, just, yeah, there's really nothing to be like scared of. There's nothing to be intimidated by any more than the regular home buying process. I know it can be a scary place and a daunting like first step into homeownership, but there's really. I mean, that's why you have help. That's why you build your tribe, right? You build your people that you want to have around you to guide you through the process. So that's how I see myself.
Yeah. And I have like, this is like a little bit of an interesting question that just kind of popped into my head, but what if you're like self-employed and you're working in this, you establish your business, you've been doing it for like 5 years, and then you decide to do something similar, but not exactly with the same employer. I don't know, like let's
Mhm.
say, I don't know how related real estate and mortgage is, but like let's say you were like, oh, okay, now I'm going to become a mortgage broker. I'm going to become a real estate agent, right?
Mhm.
Like, would they have to go back through the 2 years again, or is that kind of like a case by case?
So if it's in a different line of work, then yeah, I think it would probably be like kind of resetting the clock in a sense.
Yeah.
But if it's like a pool cleaning guy and he starts like building pools or something like that, it's like it's related, he has experience in the industry versus like a pool cleaning guy going into
Mortgages.
accounting, right? Like having his own accounting firm. Like it's like,
Right.
don't know if you don't have, and so that's what the underwriter is
Yeah.
really there to determine and say, okay, how established is this income, right? Like how likely is it to continue? Um, and what's the vitality of their business given this past experience and sort of their work history too. So a lot of it does come down to the underwriter, but as long as you have the experience in the industry, which a lot of people do, right? Like they don't just start from scratch into, this industry. Most of the time, a lot of people, have worked as a pool boy, right? Or has worked as a pool like repair man and then, started his own company. So that's a very similar or a very common story for a lot of self-employed people. So, there's really nothing to worry about as far as that goes.
Okay. Well, wonderful.
Yeah.
Well, those are all the questions I have. Yeah, anything else to add?
I don't think so. Hopefully this helps at least a few people, feel more comfortable kind of jumping into the home loan world and achieving the dream of home ownership because I know it's a dream for a lot of people. So
Yeah, as
want to
well.
make that a reality.
Yeah, for sure. Well, thank you so much for being here. I really appreciate all the knowledge. And I hope this gets out to somebody that's self-employed and thought that it wasn't possible, or maybe they were
Yep.
feeling, nervous about it. And now they can have
Hmm.
something to kind of start that planning process.
Yeah, for sure. I hope the same thing. So thanks so much for having me, Ashley.
Yeah, thanks, Catalina. And so your contact information will be down below in the description. So if they want to reach out to you, they can give you a call or shoot you an email and go from there.
Awesome. Love it. Thanks
Yes.
again.
Yes, thank you so much. Take care.